mid and small caps cannot be ignored. We are still in the bull market, first of all. If you have a longer term horizon and you can take a little more risk over the longer term, then I don't think there's any big debate. Both have their own characteristics. Large caps, for example, the Nifty 50 is expected to grow earnings, say, at about 10 to 11% for the next couple of years, whereas the small caps are expected to grow at about 15 to 20% as far as the earnings are concerned. So the small cap earnings growth looks to be higher compared to the large caps, but on the other hand, the valuation of large caps are a little bit cheaper than the small cap indices, so to say. So I think one must understand that ultimately we are buying stocks for growth, but at a certain price. So large caps offer you lower growth with a lower valuation. Small caps offer higher growth with a little higher valuation. That's why stock picking becomes so much more interesting. You just need to pick and choose and strike your balance of growth versus valuation. Certainly not, because the Indian markets have evolved. We have a large universe of stocks to choose from. There are 100 large caps, there are 150 mid caps, but in my view, there is at least another 600 to 800 stocks in the small cap universe that one can pick and choose from. More importantly, if I look at India as an evolving economy, there are so many sectors and subsectors which are evolving all the time. And if I look at the number of stocks and number of choices in these high growth sectors and subsectors, some of them are old sectors, some of them are new and evolving sectors. The sheer number of choices out there in the small cap universe is so large that you just cannot ignore the small cap universe. One must also understand that now, as we speak, almost 40% of the total market cap is in mid and small caps. So even if you want to do asset allocation, mid and small caps cannot be ignored. Certainly not. SIP, the whole concept of SIP means systematic investments, means disciplined investments. The whole idea is to ride out these kind of volatilities in the market by systematically binding yourself to a certain approach of investing. That's the only way to create long-term wealth. If we start getting swayed by short-term market fluctuations, we'll always buy high and sell low, which is not the whole point. The idea is to make sure that you are there in the market for a long period of time, because as they say, it's not timing the market that makes wealth, it's time spent in the market that creates wealth. Markets had done very well in the last couple of years, especially in the small and mid cap universe. So of course there was a bit of a froth or some kind of frenzy building up. We did see a lot of flows into this segment. NFOs and IPOs were doing very well. So it was a very bubbly market. And sometimes when you see a little bit of slowdown, which we have seen some earnings downgrade happening in the last 3 or 4 months. That that extra euphoria or extra optimism tends to get corrected, which is what we are seeing. I would say so far that it's a normal market correction, because market does tend to overshoot a bit, then correct, and then continues on its growth path. I think the factors to create a further up leg, I think we are still in the bull market, first of all. And I think the factors to take us to the next leg upward are pretty much in place. For example, the RBI has started easing on the liquidity front. We are seeing credit growth. We are hoping that credit growth will now come back because of that. The dollar has been very strong, and that's one of the big reasons why FIIs have been selling. But now with Trump coming in and making certain announcements, it will remain volatile in the next few weeks, but at least we'll have a clear policy direction. And once the dollar strength recedes a bit, we should see flows coming back to emerging markets and rest of the markets. So I think in the next few weeks we'll have a much clearer picture, and the markets should have a reason to go back on the normal growth path. I mean, again, your asset allocation should not change by short-term fluctuations, but I would say that there is a place for gold in the long-term asset allocation, and if you've already done it, you do continue with that. FDs and all are required for your short-term requirements. So if you have certain commitments or liabilities which are maturing in the next 1 year or 2 years, then obviously you do not want to place it in stocks or gold. You might want to put it in the fixed income assets like FD. But if you have a longer-term horizon and you can take a little more risk over the longer term, then gold and stocks, of course, can be considered.